All right, what's going on everyone, and welcome back to another episode of Startup Shutdown. Today, we have a slightly different topic that I'm going to try to do a longer length video for. Up to this point, our videos have either been in the short 2 to 4 minute span where we talk about short current event topics, or medium 8 to 12 minute lengths where we get a little bit more in depth into the inner workings of various business and economic ideas. However, today I want to bring you a longer form video that talks about something that I've been thinking about and working on for years, like years and years. And this is something called the equity premium puzzle. This is the biggest and most well-known unsolved problem in academic finance. It refers to the unexplained phenomenon that for over 100 years, the average return on a well-diversified portfolio of equities has far outperformed that of risk-free, short-term US treasuries. Now, this video might not be for everyone, but for those of you who are interested in and nostalgic for a short college-like lesson on my answer to the biggest mystery in finance, then get some popcorn and your thinking cap. We're gonna have some fun. And the best part is, there's no test or final at the end of this. All I ask is that you smash that thumbs up icon for the YouTube algorithm, and of course, make sure to subscribe if you haven't already. If you do that, I'll pass you for the semester. Don't tell anyone. All right, and with that, let's jump on in. Ever since it was originally discovered and formalized by Rajneesh Mehra and Edward C. Prescott in 1985, the equity premium puzzle has been the most well-known unsolved problem in the academic finance literature. Not only is it of academic interest, but it also has strong implications for successful outperforming investment strategies, and therefore is of critical interest to the entire investment management industry. In short, the equity premium puzzle describes the historical phenomenon that returns on equities have exceeded those of bonds, even when accounting for reasonable levels of risk aversion and time preferences. That is, it's hard to explain why investors would buy bonds over equities. Over the past 35 years, there have been many attempts to rationalize this phenomenon. These have included explanations involving loss aversion, liquidity preferences, tax distortions, market failure, and even a selection of survivorship biases. However, none of these explanations have been widely accepted by economists. Now, if we were to stop prominent asset managers walking down Park Avenue and ask them about what's going to happen next year, they would give a variety of answers. Some would be innovation-based, regarding particular companies' products. Others might be M&A based, regarding how companies can merge together or split apart to create more value. However, almost all would suggest answers that involve government policy, politics, and the incentives that surround them. Reflecting on the fact that incentives drive behavior, even for government entities, we realize that the attempts to explain the equity premium puzzle have ignored internal governmental incentives in their attempts to explain the apparent equity premium. And in particular, the literature has largely assumed that the posted numbers for government-produced statistics like the Consumer Price Index, CPI, and inflation have not only been unbiased, but more so, perfectly correct. But if you were to stop the average consumer on the street and ask them if they thought inflation numbers were correct, you would get a resounding, seriously? No. Does the average consumer know something that academic economists are missing? Clearly, there's a disconnect. But interestingly, if inflation was underreported by a significant enough amount and economists and the market did not sufficiently account for this underreporting, then that would account for the equity premium. This led us to investigate how the commonly quoted inflation statistics are computed by the US Bureau of Labor Statistics. In doing so, we discovered numerous mechanisms that could be used to introduce bias, whether intentionally or unintentionally. And even more interestingly in the process, we discovered a long list of strong incentives which can serve to incentivize government and affiliated officials to actually want to underreport inflation values. Now, if there ever was a true fact of life, combining the existence of a mechanism together with a strong incentive to use it almost always results in that mechanism being used. However, it is important to note that although this mechanism for underreporting inflation and the incentive to use it exists, it does not necessarily mean that those involved in the construction of these values are even consciously aware of this. Just like evolution rewards those with the best chance of survival, those economists whose chosen methodology underreports inflation, even accidentally, will tend to be more successful in their role. As both the mechanism to underreport inflation and the incentive to do so exist, incorrectly using the assumption that the quoted inflation numbers are perfectly correct in computing equity versus debt performance leads directly to the seemingly unexplainable equity premium. And to put it simply, the all too frequently relied on assumption of data correctness is just plain wrong. All right, for those unfamiliar, it's helpful to cover a short summary of what the equity premium puzzle is and why it's significant in both academic finance as well as in the broader investment management industry. In particular, it refers to the unexplained phenomenon that for over 100 years, the average return on a well-diversified portfolio of equities has far outperformed that of risk-free, short-term US treasuries. The interesting and unexplained element is not so much that equities have outperformed debt. That should be expected, especially over longer periods of time. However, this outperformance is so large that it can't be explained by any reasonable levels of risk aversion and time preferences. To illustrate this, using the risk aversion levels, which would rationalize this difference, these same investors should prefer a certain $51,300 payoff to a 50-50 chance at either $50,000 or $100,000. Naturally, there will be people who prefer the certain payoff. But it's really hard to believe that the average investor, especially institutional entities, would have that extreme level of risk aversion. Using reasonable levels of risk aversion and time preferences, the original authors suggested that the equity premium should be no greater than 0.35 to 1% per year. That is, investing in a well-diversified basket of equities should, on average, return 0.35 to 1% more per year than risk-free short-term treasuries in order to compensate for risk and time value of money. However, depending upon the country, time period, and other perspectives on the data, a range of much larger numbers have been constructed for the actual historical equity premium. One of the most widely cited papers quantifies this premium to be around 3 to 3.5% per year. However, on the more conservative side, the premium is generally accepted to be around 3 to 7% in the long run. That difference of 2 to 6.65% per year is a seemingly unexplained extra return on equities. Not only is this of academic interest, but it also has major implications for the investment management industry. In particular, if you can borrow at these low rates on debt and then invest those proceeds into equities, over the long run, you will make a ton of money with disproportionately low risk. And the greater your borrowings or leverage, the better. This is exactly the model of leveraged buyouts, LBOs, and real estate private equity. In fact, this is not only relegated to the world of investment professionals, but also directly affects around 2/3 of US households. That is, most homeowners have made use of debt financing through mortgages to finance their purchase of real estate assets. Now, up to this point in history, the attempts to explain the extra equity premium have tried to account for different perspectives on economic models, loss aversion, liquidity preferences, tax distortions, market failure, and even selection or survivorship biases. None have been widely accepted by economists. In contrast, we challenge a subtle but critical idea that deeply affects asset prices. That is, inflation and the strong incentives that exist to underreport it. All right, similarly to the equity premium puzzle summary, it's important to cover the basics of inflation, and specifically what it's supposed to represent and how it's computed. In short, inflation is defined as the measure of the general rise in local currency denominated price levels in an economy. That is, if a slice of pizza costs $3 today, and next year it costs $3.30, and everything else stayed the same, that would equate to 10% inflation in the price of pizza. Many factors drive inflation, but the main factor is growth in the supply of money. That is, if the amount of dollars increases by 10% and everything else stays exactly the same, inflation would increase by 10%. The supply of money can increase through numerous mechanisms, including, but not limited to, the Federal Reserve issuing more dollars, decreasing short-term interest rates, decreasing taxes, and even increasing government spending. In the United States, inflation is computed by the Bureau of Labor Statistics and is put together by measuring the price changes on a representative basket of goods that the typical US consumer interacts with. The difficulty with this is that there's no perfect way to measure inflation, because defining the right representative basket of goods is impossible. Not only do different US consumers experience different baskets, but more so if we define inflation as the prices on a basket of goods, which represents a subset of products in an economy, what happens to the price levels in the items not included in that basket? Are their price changes not considered inflation? Then what are they considered then? And who chooses what gets included or not included in that basket? There's a lot of room for subjective judgment and therefore statistical bias. As well, increases in money supply don't happen in a vacuum. Competitive and market forces are always at work, which can serve to decrease or increase prices completely independently of changes in monetary supply. And unfortunately, there's no good way to adjust for those competitive forces. Therefore, all inflation numbers should be considered biased estimates, no different than any other data point. Now, in order to understand the potential sources of bias and uncertainty in the quoted inflation statistics, we dug into the quantification process outlined by the US Bureau of Labor Statistics. In short, because they rightfully and transparently acknowledge that there's no one correct way to compute inflation, they use layers of weighting factors, seasonal adjustment models, sampling methodologies, and more to try to arrive at an estimated number. It's important to note that although many of these steps are given moderate transparency, none are fully detailed in such a way that an independent person could rerun the entire process and verify or arrive at the same result. Unfortunately, this fails to meet the standard of reproducibility required by the scientific method. In fact, all respected economics journals require this reproducibility too. However, it's surprising that for one of the most important statistics in the economy, this same standard cannot be met. Therefore, it doesn't take much creativity to enumerate the many ways that bias can be introduced into the final estimate, intentionally or unintentionally, with no ability to independently verify the method's quality or even validity. Therefore, as there are numerous mechanisms for bias in choosing the inflation basket and in the statistical methodology itself, it's clear there can be plenty of ways that inflation may be misstated. Fortunately, this is not a controversial opinion. A quick Google search leads to numerous academic, media, and professional sources discussing this exact topic of bias in the BLS inflation numbers. Now, with a number of clear mechanisms to subjectively bias inflation calculations, the obvious question to ask is, are there any incentives to bias these numbers in any direction? Interestingly, there are many, and they all point in the same direction, downward. First, there's the obvious one. Governments generally have an incentive to grow spending, but since raising taxes across the board isn't a very popular political position, running deficits has become the political norm. In other words, running a deficit just means that the government prints more dollars to finance its spending, thereby increasing the supply of money. This typically would lead to increases in inflation. However, if inflation increases, then the purchasing power of the country's currency decreases, therefore requiring tomorrow's deficits to be financed by even larger amounts of newly printed money from even larger deficits. That would lead to even more inflation, thereby pushing the currency into a hyperinflationary spiral. This cycle continues until the spending stops, which typically and historically has been linked to new government leadership. Therefore, as a government entity, there's a large incentive to underreport inflation as it can artificially and temporarily slow down the cycle of inflationary effects, as well as preserve one's elected seat for longer. Second, let's take a look at individual income tax brackets. As an individual makes more money in a progressive tax system, they pay an increasing amount of their income to taxes. Therefore, higher amounts of income lead not only to higher absolute amounts of paid taxes, but also higher proportions of that income going to taxes. Therefore, if the tax bracket cutoffs increase slower than actual inflation, then the government gets to collect increasing proportions of a worker's income as taxes. Therefore, government officials have a significant incentive to underreport inflation as it allows for increasing proportions of income to be collected as tax revenues due to a slower step-up adjustment for income tax bracket cutoffs. Third, and probably the easiest to see, is in capital gains taxes. Suppose you buy a house for, let's say, $100,000. Then over the years you live in the house, inflation increases by 200%. Now your house is valued at $300,000. Nothing has changed about the economy other than there is now triple the number of dollar bills floating around. Next, let's say you sell that house and move to another equivalently priced house of $300,000. To do so, you'd have to pay capital gains tax on the $200,000 gain you made on the sale of the original house. Assuming those taxes are around 20%, you'd have to pay $40,000 in taxes. Therefore, you'd only have $260,000 in proceeds from your house sale to buy the new house. But you were just trading between two houses with the exact same value. No value was made or lost, but rather the value of dollar bills decreased during that time period. Using this example, it's trivial to see that increases in inflation increase taxation on financial assets as capital gains are not inflation adjusted. And therefore, there's a material incentive to inflate asset prices to collect more tax revenue. However, if inflation was reported accurately, just as it is above, this clear loss in value would be transparent to every consumer, and they would choose to elect different officials. Therefore, it's yet another incentive to underreport inflation. Fourth, and probably the most unfortunate, is that CPI, and therefore inflation, is directly tied to payments on virtually all major government entitlement programs. As written on the BLS website, and I quote, "The index affects the income of almost 80 million people as a result of statutory action. 47.8 million Social Security beneficiaries, about 4.1 million military and federal civil service retirees and survivors, and about 22.4 million food stamp recipients." Changes in the CPI also affect the cost of lunches for the 26.7 million children who eat lunch at their school. Therefore, the higher the CPI and inflation, the more the government has to spend on these programs, therefore leading to increased budget deficits, subsequent increases in money supply, and therefore even more inflation. If you're on one of these programs, does it seem like the payments are not keeping up with the real increases in cost of living? That answer shouldn't be surprising. Fifth, and what might be the biggest reason, has to do with the interest rate payments on US Treasury debt. Quite simply, the higher the interest rate on that debt, the higher the payments the government needs to make on that debt. Therefore, the greater the interest rate, the greater the amount of dollars that need to come from somewhere to pay for that interest. Now, if we're operating in a world with a government budget surplus, then those dollars could come from that surplus. However, in a world where the government is running budget deficits, there are no residual tax dollars to pay that interest. Those dollars have to come from somewhere, otherwise the government will just default on their debt. Since defaulting would have much graver implications for a country and its leadership, the better alternative is to just simply print more dollars. Since defaulting would have much graver implications for a country and its leadership, the better alternative is to simply print more dollars to pay that interest. As expected, this creates a greater number of dollar bills in circulation, thereby inflating the currency. And from our first enumerated incentive, we know that there exists a strong incentive to run budget deficits and not surpluses, so this latter case is clearly more likely. Now, interestingly, if the public realized inflation was larger than the claimed 1 to 2%, they would demand higher interest rates on the money they loan to the government. This would therefore raise the interest payments the government would have to make on that debt, thereby forcing them to print more money to cover these payments, thus leading to even more inflation and even higher demanded interest rates. This leads again to a hyperinflationary spiral. Therefore, to slow the spiral, a government has the levers of either raising taxes, decreasing spending, or underreporting inflation. As the easiest, least transparent, and most politically popular of those is to underreport inflation, it's not surprising to expect this to happen. Well, then the question then remains, if inflation is underreported, what is the magnitude of the impact on interest payments? Looking at the outstanding Treasury debt, about 70 to 80% of all notional either matures in less than 5 years, has a floating rate, or has a rate that's directly pegged to the reported inflation numbers. The conflict of interest on floating rate notes is clear. Would you ever loan money to someone and later ask them to tell you what the interest rate that they want to pay on the debt is? No way! That's exactly what FRNs are. TIPS, or Treasury Inflation Protected Securities, are almost identical, as instead of the interest rate being set later, the inflation rate is set later, but it has the same exact effect. And lastly, debt with short-term maturities under 5 years is effectively a proxy for a floating rate note as well, especially as its principal gets rolled over and over and is never fully paid off in the world of budget deficits. Therefore, on the approximate 23.5 trillion in outstanding debt, about 18.7 to 16.4 trillion is effectively floating rate debt. So only a 1% increase in interest rates would lead the Treasury having to print another 187 to 164 billion in new dollar bills each year. Putting that in perspective, that's closer to 1% of US GDP each year, and well over 1% of the US money supply as of 2020. Now, imagine the scale of impact if inflation is underreported by multiple percentage points. This is not just an incentive, but rather a huge incentive to underreport inflation. Lastly, outside of these internal government incentives, there actually exists an external incentive too. We've frequently been taught that inflation is a bad thing and should be kept small but positive in value. However, a vast majority of people actually tend to benefit from larger amounts of inflation. In fact, these are the people who are most in debt. The more in debt someone is, the more they want their past debts to be inflated away through increased supply of money in the economy. This especially benefits those who took out debt to buy financial assets like a house. Increased inflation will decrease the relative value of one's debts while increasing the relative value of one's financial assets, like houses and equities. Therefore, whether it's conscious or not, consumers with mortgages tend to prefer governments that actually create inflation but underreport its real value. Interestingly, this also explains why balance the budget type politicians, like libertarians, find it very difficult to get elected. However, if we were ever to see a situation where less than 50% of US voters owned the house they lived in, this could change for obvious reasons. Alright, with all these strong incentives to underreport inflation, combined with these easy mechanisms to do so, it's hard to argue that the BLS posted inflation statistics are unbiased. This should be no surprise, as we're definitely not the first ones to suggest that the statistics are wrong and biased downward. In fact, we're probably closer to the 10,000th to that party. However, our contribution here is to show how that hypothesis is not only feasible, but also almost surely is the case by detailing both the mechanism for doing so and the relevant set of incentives. Then by doing so, it also justifies why the original equity premium puzzle exists. Specifically, in the previous literature, historical nominal equity returns have been adjusted by the historical inflation rates quoted by the Bureau of Labor Statistics in order to arrive at the real equity returns. That is, the inflation-adjusted equity returns. As far as we've seen, all these papers have simply taken the posted inflation statistics as perfectly accurate and used them with no adjustment for bias or potential error. However, if the historical inflation numbers were biased downward, that would result in the supposed real equity returns being biased upward, therefore resulting in a seemingly larger equity premium than one should expect. Therefore, if we overlook the critical assumption that all the input data is perfectly correct, it becomes clear why some of the smartest people in the world have spent decades failing to solve one of the most impactful problems in modern-day economics and finance, which would surely carry with it the Nobel Prize. And now, any empiricist worth their salt would then ask, well, can we prove this with data? And that's a great question. Unfortunately, there's no good way to do so, as it probably is impossible. And not surprisingly, that's exactly why this bias exists, as if there was a way to construct the correct inflation value, we'd be just adjusting everything by that already. However, as mentioned above, the gap we need to explain would be around 2 to 6.65%. Given the magnitude of these incentives, it isn't unreasonable to believe that inflation could have been understated by such a small amount, especially when averaged over the past few decades. That is, instead of the quoted 1.5% inflation over the past few years, it's not unreasonable to believe that real inflation is likely in the range of 3.5 to 8%. In fact, a quick Google search will lead you to many reasonable sources supporting this. Alright, and as an important note, we do acknowledge that underreported inflation may not make up 100% of the equity premium puzzle gap. There can and may be other factors that contribute to this premium. Our objective here is just to detail the most significant and undiscovered factor in explaining this puzzle. Alright, with this knowledge, any economist or investment professional would ask two questions. 1, how has this contributed to historical distortions in the economy? And 2, when the market realizes that inflation is materially underreported, what would be expected to change in the economy? So first, there have been massive distortions in the economy due to a blind reliance on incorrect inflation statistics. As the topic of this discussion suggests, equity holders of financial assets have received outsized returns as compared to the equivalent holders of debt. And that's mainly because debt holders have not been compensated enough for real inflation. This is especially the case for holders of US Treasury securities. In particular, investment strategies that involve large amounts of leverage or borrowing to finance asset purchases would be expected to wildly outperform. And the more borrowing at closer to the risk-free rate, the better. Interestingly, this is exactly the model of private equity LBOs, real estate private equity, and also the average consumer's financing household purchases via residential mortgages. Where else can you borrow so much money for so cheap? The fact that this is the most common investment strategy employed by the majority of consumers, where most of their net worth is invested in housing through as much as 10 to 1 or maybe even 20 to 1 leverage, creates this perpetual feedback loop. As much as consumers will say they don't like inflation, significant inflation actually benefits them directly, and in turn, they benefit from electing government leadership that will continue to inflate away the currency while underreporting it. The people who lose are those who don't own equity on financial assets like stocks and real estate. This tends to be younger people and renters who haven't made the leap to finance home ownership through debt. And as inflation increases, it continues to get harder and harder for them to purchase those houses. Sounds remarkably timely to the economic discussions in the early 2010s through early 2020, right? Now let's suppose the market realizes that inflation is being underreported. Lots will change. For simplicity and as complete analysis is outside the scope of what we're talking about here today, we'll leave it at this. Bondholders will demand higher returns on debt. That will manifest in decreasing prices on existing debt and therefore higher interest rates and yields. But there'll be many, many more ripple effects from there. The equity premium puzzle has been the biggest open question in finance, with deep interest from both academics and professionals. And although it seemed to be a deep asset pricing problem, it really has been a political economy problem at its heart, as you can't untangle the two. Combining the fact that there's no perfect way to construct correct inflation numbers with the massive incentives for government entities to underreport these numbers, blindly using the posted values and assuming that they're unbiased will lead to a seemingly unexplainable outperformance of equity. Interestingly, in the real world, this has touched every single person in the US economy. From explaining why private equity real estate investments, like those of the Blackstone Group, are wildly successful, to why the average household who financed housing through mortgage debt has also outperformed over the long run. As a final note, it's important to point out this isn't just a US phenomenon. Rather, this mechanism to underreport inflation, as well as the incentives to do so, exist in every country in the world who controls their own currency. Therefore, this has much bigger implications on the world stage. All right, and so what did you think? It's pretty interesting and eye-opening stuff when you think about things like this from a who's got what incentive perspective. And if there's one thing that I'm certain of in life, it's that at least first order, people generally do what they're incentivized to do. And those incentives don't always have to be monetary. They can really be anything. So if you see someone doing something unexplainable or maybe seemingly completely irrational, take a step back and think, what are their individual incentives here? And keep in mind, those might not always be so obvious. Anyway, if you're interested in this, I've also attached a written version of this lesson with citations for all of my data in the description below. Please feel free to download it and share it with anyone you think would find it interesting. And finally, like I said, the best part is that there's no test or final at the end of this. All I ask is that you smash the thumbs up icon for the YouTube algorithm. And of course, make sure to subscribe if you haven't already. And if you've made it this far, I think it's only fair to give you this. Thanks again, and I'll see you crazy people on the next one. Thanks again for all the support. You seriously rock.